All right. I think we will start now. Good morning, good evening, good afternoon, wherever you are in the world. Thank you for taking some time off your busy schedule. Even our panel of speakers span across 4 different time zones: East Coast, West Coast, Korea, and Sydney. So really appreciate you spending your time here. This is one of many series of virtual webinars that we'll be doing in the next few months, hosted by SparkLabs Group, which is, a network of accelerators and venture capital funds where we invest in over 280 startups across the US, Europe, and Asia. And because of SparkLabs, we are all connected, not just through the internet, but hopefully we are all brought together through an entrepreneurial spirit of creating a better world through innovation. So to give you an overview of how this webinar will be structured, our agenda will go for a total of, we'll try, 50 minutes, 45 minutes. There will be a Q&A window for any questions you may have for the panelists. We will have one of our esteemed colleagues feed us your questions at the end of the panel. We will open the floor for about 10, 15 minutes to direct questions to our distinguished panelists. So without further ado, I'll introduce you to our panel. Today's topic is called DeFi, the biggest threat to banks. Our first panelist, Kain Warwick, is the founder of Synthetix, which is basically a derivatives liquidity protocol on Ethereum. Synthetix has processed nearly hundreds of millions of dollars in trading volume, mostly through its primary trading dApp, Synthetix Exchange. He was previously the co-founder and CEO of BlueShift, a platform that supports a number of services, including counter Bitcoin purchases, deposits into digital wallets, and logistics solutions. Our second panelist is actually a SparkLabs portfolio company, Messari. Ryan Selkis, he's the co-founder and CEO of Messari. Basically, it's the Bloomberg of crypto. Ryan is an entrepreneur, an investor, and writer helping to build the Bitcoin digital currency ecosystem. He was formerly the EIR at Consensus with Joe Lubin, and was the founding member at the industry's most active investor, Digital Currency Group. And as you know, they've invested in companies like Coinbase, which is probably going to go IPO very soon, Ripple, Kraken, Grayscale, Filecoin, Blockchain, Chainalysis, Circle, and now there's a lot. and obviously the largest media brand, CoinDesk. Where Ryan was the managing director, and he led the acquisition and turnaround of the Bitcoin and blockchain technology group. Basically, they show the top news, research, and events in the business. And he's helped organize the largest industry event called Consensus, and many of you guys have been there. And he's also has an MBA from MIT. And if you guys like podcasts, definitely listen to his Unqualified Opinions podcast. So it's really, he has some really cool guests there. So, and then myself, Brian Park, I'm the moderator and the managing partner of SparkLabs Cyber and Blockchain Accelerator, we're one of many accelerators based in Washington, D.C., and we were everywhere all over the world. But this one is particularly in Washington, D.C., investing into cybersecurity startups and blockchain projects. So welcome, everybody. So my first question goes to Ryan. But before I do, I'd like to first, if you allow me, for a few minutes, if we can frame, right? If we can frame the current state of the banking system, okay? Then afterwards, we'll start with questions to you guys. So for centuries, billions of people put their money away in banks, right? The depositor would trust the bank that they will secure their hard-earned cash as they safely put it away so they can take it out again to spend. It's a very simple concept. That's why it's worked so long. The problem lies in the system where if there's too much trust without transparency, the probability of taking advantage of that misplaced trust increases in the form of corruption and greed. And the banking system is no exception. As we have witnessed, such as the panic of 1819, 1837, 1835, 1893, Wall Street crash in 1929, Great Depression 1929, the worst depression of in modern history, saving and loans crisis in 1986, the subprime mortgage crisis in 2007, which led to the movement of Occupy Wall Street, and then thus the birth of Bitcoin in 2009. Banks have failed us over and over, and the government has bailed them every single time with billions of dollars in taxpayer money. And in fact, past presidents have weighed in on the magnitude of greed that's kind of perpetuated by the banks. Andrew Jackson, and I'll make this short, guys, I promise. Andrew Jackson has quoted, "If people only understood the ranks injustice of our money and the banking system, there would be a revolution by morning." Thomas Jefferson had said, "I believe the banking institutions are more dangerous to our liberties than standing armies. If the American people ever allowed private banks to control the issue of our currency, first by inflation, then by deflation, the banks and corporations that we grow up around, the banks will deprive the people of all properties until their children wakes up homeless. The issue power should be taken from the banks and restored back to the people to whom it properly belongs." Okay, so we all know that the banking system, it needs to be fixed. And in comes DeFi, right? Where it's a decentralized finance, where it's fully transparent. You can see where, when, how money with full transparency recorded on the public ledger, and at the same time, disintermediating the banks in the process. So that's framing the banking system. So I wanted to first start the first question to Ryan. And Ryan, you have a very broad view, and you're seeing all these nice projects that are happening in the DeFi space. You have been in the heart of the industry. You have been in the heart of the industry before it was considered an industry, both as an entrepreneur, investor, journalist, from a media perspective. So, as the Bloomberg for crypto, what do you think is the most important insight or mega trends uncovered by Messari, that you've discovered in the last weeks or months, and why is it important?
Thank you very much. And let me start with two disclaimers. One, I always trip people up in their intros. I got into MIT, but I didn't end up going.
Right.
But most people, that's all they care about anyway, is that I went through the business school application vetting process. I paid my deposit. And so now that throws everybody off. So people think I have an MBA from MIT. I do not, as a confession. Second disclaimer, I'm just getting back from paternity leave, and this industry moves so ridiculously fast that, believe it or not, I've missed a good chunk of the last 6 weeks trying to keep up on Twitter, trying to keep up, amidst the chaos of having 3 boys under the age of 4. So it's been fun to watch, but I'm actually looking forward to learning from Kain as well, because I do think that the way that he and his team approached the design of their ecosystem was probably one of the more clever designs, and it's something that I think many of the other DeFi teams that have done well have actually borrowed from. And that'll bring me into my kind of core insight, I think, for the year. When we started Messari back in late 2017, I'd done quite a bit of writing about the ICO bubble at the time. And my co-founder, Dan, and I, before starting Messari, we knew we wanted to work together. We actually thought about starting an activist fund and going short the entire market. And ultimately, there was a bunch of restrictions that would have made that difficult. You didn't really trust the tickers at the exchanges. So that could have created quite a bit of blow up risk. But the reason we wanted to short the entire market is that we thought no one was actually going to use these tokens as designed. And in our opinion, there was really only 2 types of investable assets in crypto specifically. There were going to be those that were priced like currencies or commodity currencies, like Bitcoin, like Zcash, Monero, a few of the other blue chips that are still around, and maybe even like Ethereum, which at the time was being used as a reserve currency for ICOs. On the other end of the barbell, there were going to be any type of tokens that could capture value in the form of fees that would pay stakers or miners or other participants in these ecosystems in return for actually managing the ecosystem. So, there are a variety of ways that this actually works, but the most common one, at least in DeFi, is to have some type of staking mechanism where the stakers are ultimately rewarded, whether it's for providing liquidity or providing some type of governance oversight. They'd get a portion of those network fees. And those are interesting because you could actually value those like high growth securities. There is a cash flow component that flows through the network and ultimately incentivizes participation and financial staking and investment as well. And what's interesting about the conversation I think we're going to have with Kain is I think Synthetics was very, very early in recognizing not only that this was the path to actually building a community that wasn't just built on vaporware, but actually using that to their advantage to attract a good bit of liquidity. And in this ecosystem, especially, liquidity begets liquidity, and it actually made for very interesting and lucrative decentralized marketplace of some of the early synthetic assets they helped create. So when we look forward, I would look for more of the same. Right now, there are a lot of tokens built on top of tokens, and there's a lot of Ponzi-like games. It's a very fine line between an outright Ponzi scheme and a team that's using these, legitimate incentives as a bootstrapping mechanism for their network. But what I think is probably the key to look at, whether you're talking about tokenized real estate or stable coins or synthetic debt instruments or whatever it might be, at the end of the day, you're going to want to see some type of synthetic asset that you can value using some either cash flow or digital form of asset that has real world value, and then ultimately stay away from everything in between. The narrow edge of the barbell, which is just the vaporware projects or the fly-by-night operations that are really just designed for greater fool investing and a kind of game of hot potato before the card tower comes crumbling down. There's going to be a lot more of that, just like there was in 2017. But some of these networks that have real fees, real value that's getting transacted, like Synthetics, like Aave, and like Compound, money market decentralized version, are certainly going to be, I think, here for years to come, and they're going to form the backbone of this new, interesting second pillar of digital assets.
Mm-hmm. Mm-hmm. Well, we're actually, Ryan, I really like how you kind of like laid it out, right? How's the progression, kind of, mentioning. And then again, Kain, I'm going to get to you, right? Because, obviously it's a pyramid, right? There's going to be the base and it kind of builds up, right? So the base, with DeFi, it's like stable coins, right? They've got to be on ramp from fiat to get into the crypto. And then from there, what do? Like, oh, great, maybe you could lend it and get some sort of like APY off of that. And then from there, hey, also I could put this into liquidity pools like DEX, right? So you can use the AMM, right? Market making. And then there's like the oracles that kind of feed into it. And then you got the synthetics, right? Like you got the derivatives, right? And so what's really interesting, Kain, what you're kind of addressing is sort of the holy grail of the traditional finance world, which is, derivatives market. I don't know if you ever seen that little chart of how big the market is. The notional value of the derivatives markets, it's $1 quadrillion. Like it almost sounds like it's fake when someone says that, and obviously it's a very big market. And so my question to you, Kain, just kind of like leapfrog, launching off of what Ryan had talked about, being sort of at the top of that pillar, like why did you decide to start Synthetics, right? What kind of what drove you to create a product in the in the derivatives market, other than the fact it's a big ass market?
Luck and a bit of randomness, like any good startup. We started out building a stablecoin project, right? And the kind of thesis behind that was that you could create a tokenized payment network, a closed loop payment network like a PayPal or an Amex or something like that. And in creating that payment network, you could essentially establish a set of rules, right, that would allow people to come together and coordinate to produce value. And the people who produce that value, that offered this service of having this this payment network that people are consuming, would capture the value in fees, right? But if you go back to 2016, 2017, everyone was just petrified of this idea of looking like a security or being considered a security or whatever. Like, it was just like you wanted to stay as far away from that as possible, right? And then on top of that, you had the kind of investment direction, which was very much towards these kind of payment tokens of, oh, we've got an ecosystem, it's a little walled garden that we've created, and this is our little chit that allows you to pay for things within that that ecosystem, friction tokens, right? And I think ultimately that kind of forced a lot of people into the wrong direction. It was a combination of where investment was being directed and somewhat inefficient capital allocation, as well as this fear of being considered a security. But what Ryan said is critical, like and he kind of glossed over it almost a little bit, right? But like, it is the critical component that I think has been driving this DeFi wave, which is that if you build a system that produces a service, whether it's a decentralized money market protocol or some form of lending or derivatives or an exchange, and you get people to come together with a set of rules and produce that service so people consume it and pay for it, and the the revenue from performing that service flows to token holders, you have something that actually works like a normal financial instrument, right? It's not a security in the sense that it's a passive asset that you hold and just expect that someone over there is doing this action and you're going to receive an income stream from it. You have to participate in the network. You yourself also have to produce the the service itself to be able to get fees from it. And I think that's kind of the crux of what's happening in DeFi now. People have realized that actually you need to build this service. You need to coordinate people to come together, and that a token is a really powerful kind of mechanism to use to coordinate those things. And the Ponzi stuff and the weird games and like the very kind of distilled incentive structures that we're seeing right now that maybe are not sustainable, I think are just the market's way of exploring the solution space and seeing where things are, right? I think it will kind of tone down after a while, and people will kind of go back to things that have underlying value. But for a while, we've got this kind of frothy market where all kinds of crazy stuff is happening, which I think is good. I think personally it's a good process to go through, but we do need to eventually return to things that are sustainable.
Mm-hmm. Mm-hmm. Well, so I think that's a really good point. I think we have to go through go into products where the mass market can understand, right? Because it's always worked in the traditional finance market. It's like, hey, if I give money, I get an ROI for it, right? Not this yield that's and I get some yield from some sort of monopoly money, right? and that's where you can kind of figure out the 2,000% APY, right? I think my question here is like, I guess it's kind of like the elephant in the room, right? Where you have a lot of activity that's happening in the DeFi Ethereum space, and then here you have Bitcoin just kind of on the sideline, right, for this longest time. And Ryan, actually, you've actually had said this, right, where Bitcoin is kind of on the side, but then on the other side of DeFi, you got now this sort of stable coin coming in, right? So like there's all this attention, like DeFi is kind of like the hot blonde, and you got this like you got the geek Bitcoin, and then you got the stable coins are now kind of the on ramp of all this sort of money coming in. You had said in the past that stable coins is kind of like the killer app, right? That brings the kind of the critical mass into the crypto world, right? The question is like, the stable coins, what is sort of the Netscape moment, right? Of DeFi, right? And is stablecoin really sort of that killer app, right? Where, there was real uses for like stablecoins, such as like inter-exchange settlements and cross-border payments, right? And so, my question is like, what do we need to see to encourage like, like the Coinbases of the world to increase sort of the flow of capital coming into the DeFi through for stable coins? And then the second question is like how do we encourage the inflow of the cash inflow of Bitcoin to come into DeFi as well?
I still think about Bitcoin and DeFi as parallel universes in some way, and you think about Bitcoin more or less running in place for certain portions of the year outside of the big V in the financial markets in March. But I'd say stablecoins have certainly chipped away at Bitcoin's prominence in the speculation around these assets, right? Because the on-ramp today is some form of digital dollar that's going to an exchange, whether it's overseas or domestically. And those digital dollars are basically the reserve assets against which people will trade. That's very different from the last bubble, where Bitcoin was the trading pair of record on Poloniex and Bittrex and even Binance kind of early on, until Tether and some of the other stable coins became liquid enough to support all of those other trading. And by the way, it created a tax nightmare for everybody. So it's a massive boon to the industry and anyone participating in it, that you can actually peg dollar value or euro value or kind of local fiat value in a cryptographically secured asset that you can trade. But having said that, Bitcoin is really going after the digital gold narrative, and it's going to do very well in a macro environment where there's unlimited printing, and it's almost decoupled from the rest of the industry, where Bitcoin is now all about the macro narrative and its position as a bona fide investable asset for major institutions. When they're going to come, if they're going to come, those are, I think, the questions that really decide and determine how Bitcoin will ultimately, perform in the next couple of years. But for all these other assets, you can think about the levers more in micro, right? So for each one of these new DeFi protocols and new applications that's sprouting up, what are the unit economics that ultimately help people earn their returns if they're moving stable coins in or out of that protocol? So it's a subtle difference, but I think it's an important distinction between the last time and now, and maybe there's a very tiny little bit of overlap with synthetic Bitcoin, right? So one of your questions, I know you mentioned wrapped Bitcoin and the ability to borrow against Bitcoin or other crypto assets to gain leverage or to ultimately create an actual synthetic asset that's backed by real economic value, even if it's another digital asset. Right? That's interesting. Obviously, synthetics is kind of taking the lead on this. So I'll defer to Kain to maybe elaborate a little bit more if he wants to go down that rabbit hole. But I think kind of last thought on stablecoins. The stablecoins that we've seen are kind of very remedial, and the only real use case that we've seen is to encourage further speculation and oftentimes malinvestment, but speculation, we'll say right now. I think where we'll have a Netscape moment is when we get to a point where a project that looks like Libra gains mass adoption. And by that, I mean some algorithmically generated stablecoin that isn't beholden to a US bank or a European bank to custody those deposits dollar for dollar, but can actually generate them like an SDR or a true basket weighted international reserve that we haven't seen yet. Libras was shut down. There's a few other projects that are working on that that I think have promise, but they're also very, very early stage. So that's the decoupling I'm maybe looking forward to the most on the stablecoin side. In the meantime, you can have dollar pegged digital assets that are really just good for the exchanges and decentralized exchanges and liquidity in general across this new ecosystem.
Yeah, that's a great point. Hey, Kain, if you want to follow up with what Ryan said about the synth and Bitcoin and sort of, my question is that why do you have synths from the different crypto? And my thinking is, my question is it because you're allowing users to buy crypto without going through a central exchange or KYC, right? Where hey, I'm still able to participate and get Bitcoin without going through a centralized exchange to do a KYC to get Bitcoin. Now I can just go through a DEX like Synthetic and get a synthesized version of Bitcoin. Like, kind of, what was sort of your thought process of it?
Yeah, so there's assets that you cannot get direct disclosure, on Ethereum, right? Or if you can, there's trade-offs, right? Like wrapped Bitcoin, there's trade-offs, there's custody, in the same way that there's trade-offs with USDC, USDT, et cetera, where there's some custodian that you're essentially trusting to maintain the peg via redemption, right? Whereas if you have a purely synthetic asset, and what Ryan was kind of alluding to around algorithmic stablecoins and things like that, if you have an asset that is truly decoupled from either the banking infrastructure or through the need for a custodian, and exists within this kind of DEX DeFi reality on Ethereum, that's going to be very powerful. And I do think we will see experimentation there, and I do think we will see things start to emerge. But the Bitcoin kind of trend that I think is definitely going to happen, and is already starting to happen, is this movement into DeFi to try and capture yield, right? Like Bitcoin right now doesn't do much for you. It can kind of sit there, and it can essentially act as a store of value and potentially protect you from fiat inflation and money printing. But short of handing it over to a centralized exchange or like a Celsius or a Nexo, it's hard to get yield on BTC, right? Like most of the lending platforms have some form of custody required, et cetera. You can't really lend your BTC directly. And so I think this idea of allowing things like wrapped BTC, REN BTC, TBTC to migrate across into DeFi and get incorporated into things like Aave, Maker, Compound, et cetera. It's only going to accelerate this process, right? And I think the most adjacent pool of value in DeFi is Bitcoin, like by an order of magnitude, right? We've got Tether, we've got USDC, we've got all these stable coins combined, are kind of collectively $10 billion, right? And then you've got Bitcoin that's 150 billion or whatever it is today. And so I think that that you have this opportunity for people that have been sitting on Bitcoin, kind of doing nothing in some cases for years, to be brought into this decentralized finance movement and really get a sense of what the actual space has been doing for the last 4 or 5 years.
And actually, Ryan, I think Messari had a report that talks about what Kain just talked about, where there was 500 million in Bitcoin tokenized for DeFis and just representing 0.3% of Bitcoin's $200 billion market cap. So, my question to you, Ryan, is, will we see a massive movement of Bitcoin going into Ethereum ecosystem? That was my question, like my last question, to see how much do you anticipate the movement and how much money do you see that will be coming from Bitcoin into DeFi?
The short answer is I don't know. If I were to guess, I would, and I'll just talk my own book here and how I think about it. I would not sell Bitcoin to enter the Ethereum and DeFi ecosystem. An option that exists today that didn't exist, a few years ago is be able to borrow against that Bitcoin or create a synthetic version of it, and with a maybe 2 to 3x times or even more over collateralized position, take out low interest debt and actually use that and participate in some of these DeFi ecosystems with leverage. That is something that I think will absolutely happen. And it will probably tighten the ties between Bitcoin and DeFi, whereas today I do view them as very disparate in terms of the communities and general support and how people think about these assets. So I think that will change. I think it's already starting to change, but it's not a scenario where I think Bitcoin is going to lose value or lose true believers, right? You might have some new retail entrants to the market that go to Ethereum first, they go to DeFi applications first, but it's not necessarily a rotation of Bitcoin holders, Bitcoin investors out of Bitcoin. Unless it's through the form of some synthetic leverage.
Okay, great. Yeah, I mean, again, like I said, the illustration I made was like, DeFi, you got Bitcoin, you got stablecoin, and what you just described was, new entrants coming in and participating in DeFi through stablecoins rather than Bitcoin. And so a lot of folks are kind of waiting, like, is there going to be either hodling, right, through synthetics where they'll collateralize and then get a yield in the DeFi, and a lot of folks are looking at projects that they could kind of capitalize on, and new projects that you see, like, hey, we're on-ramping Bitcoin, right, like the WBTC and RAN and Keep and things like that. So I was hoping maybe you can kind of maybe give us some tips, like, are there interesting projects that are doing that? But
yeah, I mean, all right. So I know it's more fun if I say something controversial. So I'll just come out and say it. I think the most DeFi is picking up pennies in front of a steamroller, and the macro environment that we're in. I think Bitcoin could increase in value 5 to 10x with unlimited global money printing and rallies in gold. If there's just a small migration of gold investors to digital gold, then Bitcoin is going to do extremely well on a much larger market cap, and that's going to pull up the rest of the industry. But what happened, the market cap dominance metric, Bitcoin dominance metric in the industry, it kind of yo-yos, back and forth. And in 2017 and the height of the, altcoin euphoria, I think it got down into like the 30%, some region. Right before the big spike in late 2016, it had gotten all the way up to like 85% dominance. I don't think it'll ever get back up to 85% dominance, but you can pretty much bet on any time Bitcoin dominance falls below 50%, the yo-yo back is going to be intense. And what will ultimately happen is if Bitcoin starts to rally and other DeFi applications start to trade sideways, all it takes is one down day, and a lot of these ecosystems could have a pretty massive unraveling, like we saw, in the last cycle with tokens that go down, not just an order of magnitude from their highs, but orders of magnitude down, 95, 99% in some cases. I don't think that will happen in healthier ecosystems. Again, the ones that actually have real existing network fees and cash flow funneling through them, but that's a very, very small number of actual projects.
I actually kind of want to switch gears here and talk about, I guess, just the concept of decentralized exchange, right? So you got, in the past, everybody's used to, hey, if I want to, buy something, I'm going to sign up at Charles Schwab, give them my credentials, and then I got my account, I link it up to a bank, and then I can start trading, right? And the DEX world, decentralized exchange, it's, you start with a wallet, you go into an exchange, and they don't have to know exactly who you are. You can just start trading, kind of like, right? MetaMask is kind of used like as a Google profile, right? but it's totally anonymous. And so, Kain, you consider yourself a decentralized maximalist, right? I've heard from past interviews, and in fact, you put your money where your mouth is by decommissioning your foundation to give up control to 3 DAOs, right? Protocol DAO, Grant DAO, and Synthetic DAO. So then you can put more power directly in the hands of the token holders, right? And they can make a decision, the future of the protocol. But still, you were kind of like in a peculiar situation because, as complicated as synthetics and derivatives can be, you have to have some centralized, components, right? And then create sort of a vertically integrated solution first. First create a vertically integrated solution first. And then hopefully you can create the protocols that maybe the community can adopt later, right? So monkey see, monkey do. What part of synthetics is centralized and what parts aren't? And then the second part is, what's your strategy eventually peeling back the onion to eventually to make synthetic fully decentralized?
Yeah, exactly. So I think there's like the ideology, and then there's the sort of practical considerations, right? Like, so, ideologically, I believe that, things should be as decentralized as they can be, but then, you run up against sort of pragmatism and practical concerns. And when you're building an early stage project, it just requires a level of coordination that, having a fairly centralized team is often, the only way to achieve it, right? And, I mean, even Bitcoin, right, in the pre-launch phase was, 1 or 2 or 3 people, right, that were sort of working on the the software to get it to a point where it could then be released. And then at that point, other people started engaging and extending it, et cetera, and participating in the network. So I think that for something like synthetics, there's a number of aspects that are still to be decentralized that we've been working towards. Governance is one. On the spectrum, we've moved away from centralized governance to a much more open and decentralized governance framework. We're not quite there yet, and we've held off moving to full on-chain governance where it's token holders voting directly for specific proposals, just because I'm skeptical that we have the right model yet to achieve that. I think the downsides are potentially much higher, and I think the community is bought into that we need to continue with the current governance framework. But there are other aspects like the oracles that were previously centralized that have now been handed over to Chainlink. So the price feeds that sort of power the protocol are now fully out of our hands, out of even the token holders' hands. They're run by another protocol in Chainlink. There's things like public goods funding. Our grants DAO is mainly made up of community members and token holders who sort of coordinate to fund public goods. But again, it's a sort of process that is somewhat gradual, and we need to kind of keep moving towards it. Mm-hmm. But ultimately the goal is to get to a point where it's fully in the hands of token holders and fully decentralized. I think we're probably the real test is the kind of sufficiently decentralized test that Ethereum passed, right, which is a very rough test, but it's still a test that's kind of out there, the only sort of indication we have as to whether or not something has kind of gone through that inflection point. And I think we are getting close to that point where there's no single actor in the system that has control of the protocol and could act to either shut it down or modify it, et cetera, and that's a good thing.
I actually missed an important point for our audience, right? Because I think there's a lot of folks that still don't know what synthetics does, right? So if you can just very briefly talk about like, what is a synth? I mean, I know Ryan had talked about it, but in layman's term, right? Like, hey, is it a tokenized representation of assets? What type of assets, right? Like, maybe, kind of give us a broad view of like what is synthetics.
Sure. So essentially, it's a pooled collateral model. So there's a pool of collateral which comes from the SNX token, and that collateral backs various tokens that track different price feeds. So synthetic Bitcoin, synthetic Ether, things like synthetic gold and silver. But it's essentially a synthetic price exposure that you're getting. So there's no underlying asset. You can't redeem it for the underlying asset. We don't have a pile of gold sitting somewhere or Bitcoin locked up in a multi-sig. It's a purely synthetic representation of the asset on Ethereum, which has trade-offs, right? So the lack of redeemability means that the price doesn't necessarily track one-to-one all the time, which is one of the downsides. But it also means that there's no custodian that could potentially, abscond with funds or, create issues in that respect. And, the protocol is essentially designed to allow anyone who holds any one of these synthetic assets to reprice the debt into any other synthetic asset. So if you're holding synthetic silver and you want to reprice it into synthetic gold, you can turn up the contracts and you can reprice that token and get tokenized gold, synthetic gold. So that's kind of the core value prop of what we're building is a bunch of different assets that can be tracking different real world assets or external assets.
So you do commodities, gold, silver. You also do currency, right? U.S. dollar, euros, other cryptocurrencies that we talked about, Bitcoin, and then options, binary options, right? So if somebody wants to trade options, not on the central exchange, but on a decentralized exchange, they can do it. But there's you have about 40 binary options.
So the binary options are interesting because it's the first sort of user-generated market that we've created. Most of the synths require a lot of infrastructure to support them. We do ensure that the markets that they're tracking are sufficiently liquid, et cetera. With binary options, the mechanism is slightly different, but it allows you to get price exposure or hedge things that are much less liquid, right? So, we launched things like comp, when it was early trading, right? When it was going from $50 to $300 to $150. And so there was a lot of activity on those markets because people wanted to kind of hedge their exposure to comp or get exposure to price appreciation comp.
Mm-hmm, mm-hmm. And so, of all the products you have, like what is sort of the most popular that you've seen on your exchange? Because there's a lot. I mean, there's other products that you're also going to be pushing, but which I'll get into that. But what is very popular now on Synth?
I mean, in the current yield farming environment, right? This environment where people are trying to go in and operate liquidity mining on various different protocols. The synthetic US dollar is probably the most popular instrument right now. I think there's a little over 100 million in total supply, which is, it's kind of interesting. It crept up on us, right? I remember vividly when DAI hit 100 million, and everyone was kind of freaking out. It was this crazy milestone, right? And we just quietly hit 100 million in SUSD, and no one really even noticed, right? So at the moment, there's a lot of demand for that, but things like synthetic Bitcoin, there's a lot of demand for as well, synthetic Ether, and some of the other assets. Probably the most exotic asset that there's decent demand for is the synthetic DeFi index, as you can imagine, right? Everyone's excited about DeFi. There's 12 different DeFi tokens that are in this basket of, it's like an index token that represents all DeFi. So, that's had a lot of open interest, up to, I think, $5 million at some points over the last few months.
It's almost like an ETF.
Exactly. Yeah. It just tracks all of the different, comp and lend and SNX, et cetera.
Mm-hmm. And then I heard that you'll be releasing new future features called futures. And so my question would be like, you know, what sort of futures are you thinking? I mean, like the most popular one on the central exchange is S&P and euro dollars and crude oil and treasury. Are you guys going to do something similar to that?
So we've been working on a crude oil representation, a price feed, right? Like a canonical price feed for crude oil for 6 months now. And it turns out, you know, when you're working with a legacy financial system and you need to ingest data from the futures markets, it's very difficult. You know, there's a lot of overhead. So we've been working with Chainlink to get those data feeds provisioned, but you know, it's taken a long time, a lot longer than we expected. But once that's done, it will give us kind of access to, you know, essentially all the different commodity futures markets, you know, different precious metals, et cetera. But we're really, you know, trying to kind of nail the crude oil. So it's probably going to end up being Brent crude, I think, that will be launched first. So yeah, that's going to be a big deal, hopefully in the next month or so. But you know, the licensing for those data feeds has been pretty painful.
And then the other commodities, are you thinking about expanding on the commodities as well? Like, or I'm sorry, the crops. So you know, you got soybeans, corn. You know,
yeah.
do you have
I don't think there's a yam. I don't think there's a yam future on ice, but maybe we can. Yeah, exactly. I know, right? Pasta. Maybe we can get like a cross pollination going and get them to list yam futures or something. So.
Right. And then I noticed, like, on your website you have stocks, right? So actual equities, but there's nothing there. Are you guys thinking about, you know, launching that soon, or is that wait and see what happens?
So we actually launched the FTSE and Nikkei, but there wasn't a huge amount of interest. A, because they're indices, so they're kind of, you know, slow moving and not very exciting. You know, even in the current macro environment. So I think that the plan is to let the community propose some additional equity-based synths in the future. So that could be, you know, individual things like Tesla, for example, you know, or it could be Apple, Amazon, etc. But you know, we're just kind of, I think we just got through the point where we had all the Chainlink feeds migrated, which is a big component of that. So you know, my guess is that it's probably 2 or 3 months away before we, you know, try and list some other equities and see if there's demand for it. You know, there was an assumption that there would be demand, but it wasn't a massive amount of demand for the FTSE.
So actually, this is a really good question to ask Ryan, right? Because, you know, it's always about like getting real world use cases, and you know, as Kain talked about, like a Tesla or Apple stock. I mean, you know, Amazon. I mean, it's pretty expensive, right? Like to buy one, and then, you know, to get a fractional ownership through DeFi or decentralized exchange. Like, do you think that would become a thing, right? You know, what has your research, you know, shown?
You know, I think that there's plenty of fintechs now that are making fractionalized shares much easier to acquire. That's less interesting. I think what's more interesting is the fact that this opens up and makes globally relevant certain markets that are otherwise restricted. And maybe the most important piece of infrastructure that still needs to be built out is reliable data and Oracle middleware that can convert actual stock and commodity prices into these smart contracts and these synthetic assets. You know, Kain and team know this all too well from you know, last year, and kind of learned trial by fire, you know, some of the potential issues if you have one Oracle go down and corrupt the smart contract. Now, luckily, that was at a much different time in the market cycle. So, you know, the highs right now are kind of built on a much more resilient stack. But if you think about the ultimate value of DeFi and synthetic assets in particular, I would think that you're going to see a significant cycle where the ability for an investor in Indonesia to buy shares of U.S. traded stocks, or you take less liquid markets, right? Like any international investors that are trying to actively invest in different African countries, or Eastern European countries or Southeast Asian countries. That is going to be much more readily available. And you're going to be able to do this with DeFi protocols more easily, because there's no throat to choke as a regulator in all these different geographies if you're running afoul of certain trading restrictions. And this isn't necessarily money laundering. It's not necessarily running afoul of like even investor accreditation laws. We're talking about public securities that are easily accessible to people within certain physical locations that are otherwise difficult or impossible to get. The other area that this becomes interesting is OTC trading after hours, right? Nights, weekends, holidays. Crypto can do that. The OTC markets and regulated securities, markets are just much less liquid at certain times of day. For a crypto trader, it seems like nonsense, right? So those synthetic assets will probably always deliver real-time price discovery in a more reliable way. I'd say in relatively short order, once the actual protocols are built and the different parts of that stack are made robust, and the edges are whittled off in the course of the next 3 to 5 years as part of this next cycle.
Great. So we're going to open up for Q&A. We have one question, but before I do, I want to ask sort of a wrapping up a question for both of you. Like, where do you see your prospective companies, a year from now, 5 years from now? And, what is sort of your long-term vision that if you had a wand, and it could come true tomorrow, what would that be? So, I'll start with Kain. What would that be?
So I think, the project at this point is still in a very early stage, but ultimately what we want to get to is the ability for, as Ryan mentioned, anyone who's got access to an internet connection to be able to have, price exposure to any asset in the world that, is easily tradable. So any liquid market that, be able to sort of, cross any border. And there's a whole bunch of things that need to happen, things that, for example, we're not responsible for, thankfully, like scaling, on-ramps and off-ramps to, various jurisdictions, et cetera, better banking infrastructure for crypto. But there are things that we're also, we are responsible for, so building out the actual protocol itself. So I think that over the next 2 to 3 years, we will really see, the infrastructure get much more robust and see a lot more investment into that maybe hasn't happened over the last 2 or 3 years through the bear market. But I think we're now getting back into a market cycle where a lot more investment's going to come online, and we're going to have a lot of infrastructure built out, and it's going to make it much easier to bridge those gaps. So I'm excited to see all of that happen, and I think it's going to play out in a very interesting way in the next 2 years.
Ryan?
Yeah, I mean, the shorthands, Bloomberg for crypto, I guess is the easy cocktail hour answer to this question. And that's not too far from our mission, right? Our mission is to organize and curate information for professionals that are accessing this industry for the first time. And I think our team has done a good job of that. We're asset centric, so we do a very good job of covering the top several hundred investable assets throughout the global ecosystem. And look, we're covering an addressable universe of maybe 300 assets that have any type of liquidity or market cap, above the single-digit millions. So we think that market's going to be 100 times bigger in 5 years, and we will be 100 times bigger as an information provider and data provider catering to that asset class. So pretty simple, plain vanilla, but we rely on guys like Kain, who's in full disclosure a partner of ours. So we certainly think that there's going to be a lot more work to do in helping people understand just what the hell they're buying.
We have a question here on the Q&A. So this one is directed at Kain. Talking about crops, have you looked at parametric weather index insurance, structurally similar to weather derivatives, but licensed as insurance, so it can be sold by to any farmer? 560 million farmers globally, 550 million are poor and very vulnerable to weather variables.
So we haven't, but one of the, I think, most interesting sort of developments that I've been following over the last like 3 to 6 months is the emergence of a bunch of new protocols that are targeting risk. Risk swaps, credit swaps, etc. So I think that we will see some really interesting risk protocols that will allow for things like weather insurance and various other aspects. But we can build these protocols and we can build them on Ethereum. We can make them amazing. But as I kind of alluded to in the previous answer, we need the infrastructure to be able to kind of bridge the gap from anyone with a smartphone being able to kind of onboard and get value into the ecosystem and back out of it again. So I think that we're still a ways away from being able to tap into those 500 million farmers around the world, but it is getting closer. I think we're much closer, and another couple of years of investment and these things will become much more accessible.
Okay, hope that answered the question. And then another question to Ryan. What is the best project that you're most impressed with that nobody knows about? I think it's another question, like, tips, I guess.
Yeah, so just someone that wants to go dumpster diving for the next great 100x return. I'm not going to play that game, but I will share just what my own personal holdings are and the largest position that I have. So my portfolio is basically Bitcoin, Ethereum, Zcash, and then a few smaller projects. Maybe the most interesting outside of the DeFi protocols, which I think about kind of as a basket. We talked about some of them. Synthetics being one, Aave, which is a lending protocol, being another, Compound the Money Market being another. Those are probably the blue chip, I guess, DeFi assets, along with an up and coming project called Wi-Fi, Yearn Finance.
Mm-hmm.
But I think maybe the next major super cycle from an investment meme standpoint is actually going to be around decentralized autonomous organizations, and maybe the biggest project in that regard, most active project that's basically facilitated the creation and management of DAOs is a project called Aragon. So this, I think, probably my fourth largest personal holding. You can read into that what you will, but it is something I'm very bullish on, despite the inauspicious start that we had in 2016 with what was an attack at the time that almost took down the Ethereum network.
Right. Okay, and so one last question for each of you, and as a moderator, I can ask any questions I want. And so, what's your prediction of Bitcoin at the end of this year? It's going to be
30,000.
30,000, huh?
30,000.
30,000? Okay. Yeah, because you had tweeted 25,000 a few weeks ago, so it's gone up now. Ryan, yeah. So 30,000.
There's absolutely no cost to being wrong.
Yeah. I I tweeted something a few weeks ago, or maybe a week ago, which triggered a lot of people, where I said, I thought that there was now like a decent chance, and this kind of taps into an answer from Ryan, earlier, around the fact that a lot of people forget that structurally Bitcoin was, the quote currency for every other alt for a long time, right? And if you wanted to get access to anything, whether it was Litecoin or Zcash or whatever, you're trading it against BTC. And, a lot of the newer people into the space just don't get that. And the people who weren't traders don't get it either, right? If they just came in as a venture style, investor who was buying an asset and sitting on it and weren't trading, they don't get that dynamic. And that's just changed. It's changed radically in a way that I didn't expect to see, where now, you've got a bunch of different fiat currencies or tokenized fiat currencies that things are trading against. And, I said, I think there's a decent chance, not a non-trivial chance, that Bitcoin doesn't move much at all in this cycle. If the macro conditions don't play out in the way that we think, where, the digital gold narrative doesn't really, get a lot of traction, then it could just float around where it is now for a while. But I do think that there is a reasonable chance that the macro conditions will push it up, 2 or 3-fold potentially. But I think it's also possible that doesn't take off and it doesn't move much.
So 2 or 3-fold, that's what, again, 20, 30,000?
25, yeah, 25, 30K.
25, okay.
Yeah. I mean, 20K is going to be a hard mark to push through, I think. I think there's a lot of people that are going to be looking to take profits ahead of 20K. So, psychologically, it's going to take I think if we break 20K, the sky's the limit, but it's going to be hard to break 20K.
Well, I think we hit 10 o'clock. That's the end of our time. And I want to thank you, Ryan and Kain, for participating. And I know it's kind of challenging times right now in COVID, but through events like this, it makes us a little bit more closer to each other, and makes life a little bit more exciting. So thank you for participating. And again, we will have series of these webinars over the next month, including our famous demo days, right, from our various accelerator programs. So please sign up at SparkLabs newsletter. And I want to thank you all for your questions and feedbacks, and stay safe, and hopefully we will be able to catch up very soon. If not in person, we can do it online, which is just as good. So thank you very much, Kain and Ryan, for participating.
Thanks, Brian.
Thank you.
Appreciate it.
Okay.
Thanks. Good to see you, Ryan.
Yeah.
Likewise. Catch up soon. Cheers.
Bye.